Okay, it's 12 o'clock. Let me get the recording going and we can get going properly. I've got a super exciting session to share with you. And we've just invented something that no one has seen before because it was invented 1 hour ago, which I'm going to share with you. I'd love to see what your inputs are. So let me just see, is Kelly here? Where is she? Okay, let me rock and roll. So the first thing that I wanted to share was I had a interesting conversation. I've had it twice this week. So I had it once earlier in the week, and then I had it again this morning. And it was from someone asking, do I qualify to come to the Wealth Weekend? And it was interesting because the mindset is, well, I don't know if I've got enough money. I don't know if I'm good enough. And people don't say this, but this is what we all think. Okay. Am I at the right level? Am I good enough? You know, do I qualify? All of these type of things. And what is so important is that I just wanted to start off and say that anyone that is on this journey, anyone that's turning up on a Friday, anyone that's doing Wealth Going Global or part of the Wealth Hackers or part of the mastermind, every single person qualifies. Because the single most important thing that you need is to have the belief and the desire to get what you want. And, for me, what I learned a long time ago, I don't even really remember how I learned it, was just to put yourself in the room. Now, a lot of people think that they don't qualify or they're not at the right level or whatever. But what's so interesting is that everyone has the same insecurities. We had one gentleman join or want to join the mastermind, and he met with Alex and he said, look, I don't know if I qualify for the mastermind. I've got 100 million in net assets and I'm not sure if I qualify. And it made me realize that it doesn't matter who you are, different people have different perceptions of like, do they have enough? Are they good enough? Are they at the right level, et cetera, et cetera. So I just wanted to acknowledge that. And if anyone else is feeling like that or has that fear, you don't have to publicly say it, but I just wanted to own that right up front because we create the Wealth Weekend to be in the environment where, Susanna came and joined us in March, and Susanna, is at the beginning of her journey, but she had amazing insights and incredible clarity. And what was so valuable about Susanna being there was she also helped me because she helped me. When you've done something for 28 years, you've forgotten, like you don't even know what people don't know. You talk about assets just on the assumption everyone even knows what an asset is. It's a good example. Like I talk about the top 15 assets, and there's a lot of people don't even know what an asset is. Do you understand do you understand where I'm going? So it's very useful sometimes for people to be able to say, and that's why I always ask, like, again, these Friday afternoon sessions are supposed to be question and answer. Like there's supposed to be more dialogue and questions than just me talking. Because I'm here to help. Like no matter what the question is, like there's no stupid question. The only stupid question is the one that's not asked. Okay, so I just want to kind of start with that. Now that whether that's Wealth Going Global or any other course that you're on or something that came up this week, like hit me with the question. And the thing that irritates me the most, if I'm honest, is when I'm out there and I'm talking to someone and they say, and they ask a question and they don't think it's a great question or it's something that's been worrying them or bothering them. Would you please just ask that publicly? Because they are like everyone else feeling that same way. So back to the Wealth Weekend, if you can be there in person, I cannot recommend it more because no matter what level you're at, it's going to be so valuable to be rubbing shoulders and we're going to be dialoguing. Like what we're doing now for this hour, imagine doing that for 2.5 days. Like where you can ask anyone any questions. And sorry, there's a whole bunch of people coming in the room here. Let me just get everyone in because I need to get Kelly properly sorted so we can help quickly.
Hi, I'm here. There was something wrong with the link, but I'm here now. If you want to make me co-host, I'll sort it out.
No problem. Okay,
Thanks.
I didn't realize there were like 12 people in the waiting room. So if you don't mind, for those who were in the room, and I apologize, Joanna, do you want to start with your question? I'm going to come back to what I was just talking about because it's actually so important for the 12 or 13 people that were stuck outside. I'm going to repeat myself, but do you want to just go go with your question first before I carry on.
Okay. I had a message from you which said that people that attend the mastermind meetings are 7 times more successful than those that don't. I was just curious as to what your measurement criteria is for that statistic.
So I'd love to. Could you send me that video? No, because what I think I'm just kind of shooting from the hip here. But there is a stat that's done. There's actually a video I can show you where people that are part of masterminds achieve results 5 times quicker than people that are doing it with a coach or a consultant. So I think that's where the 5 times comes from. I don't remember 7 times, and if I said that, I apologize because I don't have a metric. It's not like this person and that person. But what I said is words like geometrically different, if that makes sense. Okay, but between those that attend and those that don't. And I tell you one reason. It comes down to one word. Can anyone guess what the word is? Let's make this interactive. Anyone just type in the chat box anything. What is the one thing that people that attend the Wild Weekend get and those that don't? So I can see accountability, trust, connection. Okay, it's trust. So because of you can get any knowledge you want in the world, but if you don't quite trust it, or some level you don't trust yourself, then you tend to not do it. Okay, and it doesn't work, and you might make mistakes and all that. So the thing that people get by attending the Wealth Weekend, and I'm talking primarily now in person, you get to be in the room. You actually meet the family office in person. You're shaking their hands. You talk about looking someone in the eye. You're having a drink with them. You're being human with people, and that means that you really build trust. Okay. With the people that you're working with, the partners, me included, our team, we're all there. Like, does that make sense? You're literally meeting people physically in person. The second thing that you do is you really start to trust yourself, because you go into this stuff deeper. Like, it's 2.5 days of proper immersion, like understanding, and it's where I was kind of going to, where it's panels and you can ask any questions you want. And so there becomes a deep understanding of, like, what is this process, and do I trust myself, and do I trust myself to be able to ask the right questions, and actually realizing that my questions are quite similar to the person next door. Because when we sit on Zoom, you sit there and go, I don't want to ask that question. I don't want to look like a doffy. But actually, when you sit in the room and you realize everyone else is asking questions, well, why can't I ask questions? Does that make sense? So it's trust in self. And the final thing is trust in the plan, and actually the belief that the plan's going to work. So because when you've sat in the room and you met people and you've been on this journey, now you've met the partners, you've trusted yourself, and you've got a plan. Now it's like trust. Like, I actually trust this is going to work. And so for me, Shona, if I was to answer your question, like, that's what I was trying to say. And we've gone as far as, like, the Wealth Weekend was actually created as a nice to have on top of the month. It was like, hey, we don't get a time to actually meet in human person. Let's create a weekend to get together. To actually going, it should be compulsory as part of the mastermind because of that one single word, trust. Okay. And, if I look across the 120 families plus minus that are part of the mastermind, that's the geometric difference. So if I said 7 times, I apologize. I don't think I did. I've got no metric to back that up. But the point
might be misrepresenting you there. Yeah. I just picked that number.
But the point is, it is geometrically different. It is really different. And even I've noticed people that, like with Calio, who the family office, they basically say, well, in the beginning, people might want to dabble, but then you spend real time with them and you get to know them and they're humans. And I go as far back as Derek, like Derek, the farmer that, often speaks and people know who he is. He didn't trust them for like an entire year. He was like, even the mastermind, he was like, I don't really know what's going on here. I don't trust you. It's like, I'm stuck on my farm in the middle of nowhere, blah, blah, blah. And then one day he had a meeting in Johannesburg, and somehow, I can't remember exactly what happened. He got invited by them to be part of something, and he turned up and he had like an hour talk to Anthony, and it wasn't even a meeting. It was just an impromptu. He just randomly, Anthony happened to be there, and they ended up meeting, and that's been the change for Derek, like that human connection. Does that make sense? So it's maybe a good story that kind of explains to everyone. And reverse engineering your question and what I was talking about, and I apologize for those who heard this just now, but I'm just repeating it for all the people who weren't in the room. It's like, I've had people say to me, well, do I qualify for the Wealth Weekend? Am I at the right level? And my answer to you is, if you're on Wealth Going Global, if you're turning up on a Friday, if you're part of Wealth Hackers, if you're part of the mastermind, then yes, you qualify. Because it's about getting in the room. It's about rubbing shoulders with the right people. And you know, a lot of us feel unworthy or not at the right level. By the way, back to Tony Robbins, and now I'm going to personal development. If you break down every single human and you ask enough questions, it eventually comes down to one or two underlying things. You either feel I am not loved, or you feel you're not good enough. It's one of those two. Okay. So just by the way, if you're feeling that, you're literally like every other human on the planet. Okay. So no matter what level at, people are like, am I good enough to be in this room? It's natural. And that's why I try very hard to take myself out of the comfort zone and put myself in an environment where I'm the dumbest, poorest person. That's why I say that. You've heard me all say that many times.
Yeah.
Because if you're in that environment, you can only pull yourself up. Okay. And no matter what level you put yourself, maybe you're a beginner, maybe you're an intermediate, maybe you're advanced and sophisticated. Well, even if you're advanced and sophisticated, God will blow your mind, because he deals with people that are more advanced than you. So no matter what level you add, you can be pulled up if you put yourself in the right environment. And I was just telling the story earlier of Susanna and how, I mean, Alan, you were there. I don't know if anyone else was there in March, but you know, Susanna's really at the beginning of her investment financial journey. But you know, she asked brilliant questions at the Wealth Weekend, and really asked sometimes what some would refer to as, let's call it, simple questions, but they're foundational questions. They're like exactly what everyone needs to know, and that's incredibly valuable for everyone. So yeah, I want to kind of nip that fear or concern in the bud for everyone. Obviously, if you turn up online, you can sit in your little room and you don't have to worry, and there's no comfort zone leaving, and you're just going to get.
Oh no, I'd love to go, but I just can't afford to get there. But I'll come to the Portugal one.
We're gonna figure that out for you. We're gonna figure that.
I'll come to Portugal. I'll be there.
No, Shona, we're gonna figure that out for you. As I said, next year I'm going in 2 weeks to spend a week with Paula Mahoney to plan the stuff. Because when I do it in Europe, I want to do it properly. I don't want to.
Yeah.
That's going to be very expensive, and we need to do it properly.
Yeah.
And I just think, you know, I don't want to waste this whole session talking about this, but I wanted to acknowledge this, and I think, Shona, it's a brilliant question, because this is the essence of it. And I think I'm now going probably too deep into this, but my belief system is, since COVID, we've all learned this online stuff. I mean, you can see I've built a big fancy studio and everything, and you know, with all due respect, like, I love being here, because in 2 hours I'm going to be on my boat, or 3 hours, whatever it is. You know, I'm not in some hotel in Johannesburg or London or anywhere else. But the one thing we all crave is human connection. Okay, and you don't get human connection on Zoom. Like, you get a bit of it, you get community. It's better than being on your own. But the point being is, you can't shake someone's hand and have a drink with them and get to know them, and like, whatever. Buy a drink, it can be coffee, just in case you don't like a beer and wine. But you get my point. And that's where the real human connection comes. And so my belief system is that someone like a Tony Robbins or a Scott Picken will be running an event, and you'll pay 10 times more to be in the room when it's live, because there's so many extra things that happen when you're live in the room. And you'll pay, I don't know what the exact math is, so Shona, don't hold me to my exact metric, but 10 less if you're online, because you still, like, if you go to Tony Robbins and you do his IRW, what's it? Anyway, his 4-day like entry level thing. You know, I remember many years ago paying £700 for that. I mean, I was young, I was in London, £700, a hell of a lot of money for me. But you had to physically turn up in London to go to it. Now you can get online, and, you know, but it's nowhere near the same experience, like being online versus being in the room. Yet you can now host not 20,000 people, but like 1 million people. Do you understand what I'm trying to get at? So just back to the Wealth Weekend, that's why we've made it still, we're doing it in person. We do IPW. That's it. Thanks, Shimon. That's why we do both. And that's why Kelly kindly has got proper videographers and stuff, because actually the very first time we did it online was in March. And we just literally stuck a Zoom camera up and said, good luck, watch. And the reason being is that it's so valuable that I don't want people to miss it. So, there's just so much valuable stuff in that room. But I just want to be very clear that being physically there is very different from being online, because you're not, like, we got physical experiences that you can't replicate in online. Mike, I see you got your hand up. I know you had a question around IRR. So yeah.
Yeah. Thanks, Scott. Hi. Yeah, just a question around, when you show your investments that you've done in the past and projected ones, you put the IRR down. I know what IRR means because my throat. But isn't it more like an estimated thing? Because doesn't it depend on what happens in the intervening years as to whether you get that IRR?
Yeah, completely. So remember, with any IRR, which, just for everyone, internal rate, IRR stands for internal rate of return. And it always has a target exit. So notice the word I'm using, target. Okay, you can't so it's not a guaranteed exit. You've got to have a target exit. But the way that it's calculated, there's 27 variables that are taken into account with regards to internal rate of return, IRR. And it's the best financial metric out there. So just to be clear, I've got a little video that I'm going to share with the community on the difference between yield, cash on cash, and IRR, internal rate of return. Now, what happens in the way we watered down in the world is that most of us are taught ROI, return on investment. And I know we're going into acronyms and everything here, but return on investment is simple. Okay, so say, for example, I put in $100 and I get $20 back. Then my return on investment is 20%. Everyone with me so far? Yeah. Now, the industry likes to water it down, so we think of ourselves in ROI and on the one side of the fence, and then yield on the other side of the fence. So yield comes to property. So it's the same thing in property. Okay, if I own a property in London and I bought it for £100, £100, and I'm getting like 10% a year. $10 a year. I'm basically getting it's a 10% yield. I'm very simplifying it. I know people can get more complicated, but it's basically a 10% yield. And so a salesman and an estate agent will sell it as a 10% yield. And everyone runs around like, that's super exciting. But the problem is you got a mortgage on that property, and you got your rates and taxes, and you got your management fees, and you got your maintenance, and you got your vacancies and your voids, and you take out all of that stuff. So that money never actually came into your pocket. And let's say only £1 turned up in your pocket. Okay, well then the cash on cash return is 1%. So again, £1 over £100 is 1%. Are you with me? So a salesman will sell that to you, and a financial planner will sell that to you as a 10% yield. But what you need to know is your cash on cash. How much income is it putting into my pocket? Are you with me so far? And I haven't lost your train of thought, Mike. I'm coming back to, because I'm going to start with income first, and then I'm going to go to income plus capital growth, which is where IRR comes in. So income, you want to know. So the retail way of doing it is yield, and that's how they always sell things. Buy this house in Portugal and you'll make a 12% yield. Is rubbish. After all the expenses, you might get a 2% cash on cash. Are you with me? And then on the other side of the fence, the other metric you have to know is some sort of projection around how long are you going to hold that asset for. Because it's very different if you have an asset for 12 months versus an asset for 5 years. So ROI doesn't take that into account. It's just kind of often ROI, they don't even, it can be 5 years, and if I put in £100 and in 5 years' time I get back £100, I've often seen people go, oh, that's 100% ROI. Just if anyone disagrees with me, please say I disagree. At a very simple level, it's bullshit, because it's 100 divided by 5, which means it's 20. I mean, at an absolute basic, it would be 20% ROI per year. if you want to compare an apple with an apple. And then what Mike's asking, which is IRR, internal rate of return, it gets more sophisticated. It takes all the variables. It takes inflation into account, takes time value of money into account, takes the capital appreciation. However, to do the calculation, you've got to have a target exit that you're expecting. And that's why you'll notice always in our languaging, it's always a target IRR in terms of, because it's not guaranteed. Nothing's guaranteed until it's exited, if that makes sense. Now, again, why is this so important? Well, on the one side of the fence, you've got income, and you've got to make sure that you've got the right metric. It's not yield. Yield is irrelevant. Cash on cash is what puts in your pocket. And the only thing you're ever going to retire on is income. Yes or no? How many wealthy people do you know? I meet them all the time in the mastermind that have lots of money and assets, but no income. There's very little freedom in that. Particularly when you get older, and I'm talking older being in your mid to late 60s, and you own all this property, and even though it might be paid off cash, unfortunately, I meet a lot of people like this, but they don't have enough cash flow and they can't get any debt from the bank. You know, the old proverbial, just go and get an access loan or whatever. Well, the bank doesn't give it anymore. And so now they got all this wealth on paper, but they actually got no income. That's not freedom. That's financially trapped. You hear me talk about that all the time. So cash on cash is the metric which equals your freedom. And then IRR, which takes into account your income plus your capital growth, is ultimately how your capital grows, like how your wealth grows, how your return grows. And that's why you got to know both.
Can I ask a follow-up question, Scott?
Yeah, please.
Yeah.
Please, and before you ask your question, Mike, did what I just say make sense in terms of the importance of those two? Or
Yeah.
So your follow-up, yeah.
So what would be useful for me to know is, because you've got these target IRRs, but you've done a lot of deals now. It'd be interesting to know what the actual IRR was compared to what the expected was. What was the actual performance of these things compared to, like, okay, this is our estimate of including the exit. You know what I'm saying?
Yeah. So the average return for us over the last 10 years has been an IRR of about 14%.
Okay.
And very interesting and weird, because remember, we've only been working with the family office in this mastermind environment for 2.5 years. I asked Anthony to go back and give me his metrics on their overall portfolio return. It was 14%, which I found uncanny, because we didn't do the same deals, okay, like different stuff. So, and that's why you'll often see me when we do this financial calculator and financial modeling. I'll say to people, somewhere between 12 to 15% as a target IRR return is reasonable. Like 12% on the conservative side. By 15, you're starting to get aggressive. If you're putting in anything north of 15, you're being too aggressive, in my opinion. You're going to have some assets that will give you 20%. Great. But you're also going to have some that will give you 10.
Can you just clarify, is that example you've given us on IRR of 14% on property? Or if I take 100 Rand, $100 and I invested for the year, and at the end of the year, I've got $110.
Yeah, so I think Alan, it's generally like if you take it, it's an average across different assets. So if you take, we've got assets that are debt products that are purely income. So there is no capital growth. There's just purely an income return, or structured note that purely is an income. There's no capital growth. And then you've got other assets like private equity or property where there is capital growth and they might be higher than 15%. But when you balance the two out and sort of put it together as a portfolio, you're looking at around 13, 14%, basically.
Okay, sorry, I'm stupid here. I still don't understand. I give you $100 to invest in the stock market. I say, put it on Alan Gray. After all the fees and everything, at the end of the year, the investment in money terms, if I cashed it in, is 110 Rand.
Yep.
What is that rate of internal that one should be getting if you're investing in the market in money, dollars, cash, or whatever?
So again,
a year?
like obviously different assets are different.
I don't know, I understand, but then what should we be watching for? What should we be getting?
So there was a gentleman that I spoke to about 2 or 3 weeks ago, and he had his money here in South Africa, and he was getting about 5.5%. And what was really interesting is he said to me, Scott, I don't know if that's any good. I really trust my financial advisor. I really like him. In fact, he's been a family friend for 25 years. He's recently passed away a month ago, which is the only reason he was talking to us, by the way. Otherwise, he would have stayed with his family friend who he trusted. And he came along to us and he said, and he's asking the exact same questions, Alan, you're asking. He goes, is 5.5% any good? And I said, in what currency? And he said, rands. I said, no, dude, it's not. You should be getting at least 10%.
That after everybody's taken their fees and
yeah,
management, all the stuff that goes on, all that gets thing, you should be getting on investment 10% after all costs.
Correct. Remember, Alan, anyone worth their salt, when they're giving you returns, like if I go to Wealth Migrate, just 2 seconds, I'm just going to log in and so I can share my screen with you. Anyone worth their salt, when they're giving you returns, should be giving you net returns of what's ending up in your pocket. No one, sorry to swear, but no one gives a shit if you're making a 20%, gross return, but only get paid 6. The number 6.
It's the correct figure.
Yeah, the correct figure is what you get in your bank account. And so if you go to any of our returns, every single one of these returns is net. It's what you get in your pocket.
Okay, that's not proper. What do you...
Sorry, just quickly, Alan. One of the things that I've got a massive issue with, again, in the industry, and one of the things we struggle with, is I have people come to me and goes, yeah, but I'm getting 20%, down the road. And I go, okay, is that gross or net? Oh, I don't know. I don't even know what the fees are. I'm like, okay, great. For me, what's important is, what are you getting in your pocket? So someone will compare an apple with an orange. And I say, well, Scott, you're giving me an 8 and this person's giving me a 15. And I'm like, okay, but hang on, is it gross or net? There should actually be a rule. The regulator should bring it out as a rule, in my opinion. It should just be net. That's it. What do you get in your pocket? End of conversation.
Okay.
But also, I think what we're doing in this conversation, like what you've just experienced, all of you, in the last 10 to 15 minutes, and thank you, Mike, for asking the question, is the most valuable. To win at investing, you have to be able to speak the language of investing. To win in China, you have to speak Mandarin. It's that simple, okay? And to understand cash on cash, an internal rate of return, is to speak the language of investing. So if you ever talk ever again to a financial advisor and they tell you returns, like Alan's asking the right questions. And Alan will be the first to admit to you that 5 years ago or 10 years ago, I don't know the exact timing, Alan, 5, 6, 7 years ago, before he did all of the studying, most people don't even know the impact that fees have. And I know Ann Wilson teaches this all the time as well. And so they all see these headline numbers. We walk through the airports. Oh, just by the way, I got a funny story. Someone asked me about Shona was a dude that asked me about my holidays. So going down to Cape Town with Jonty, we're walking through the airport, me and him, he goes, Daddy, why is your company not advertised in the airport? It's all the biggest financial houses and whatever. And I said to him, yeah, well, it costs quite a lot of money to advertise at the airport. But I mean, look, aspirationally, I'd love to walk through the airport one day and see us there. But the thing is, when you go through the airport, and anyone that's ever traveled knows what I'm talking about, you go through the airport and it's all this highfalutin, give us your money, trust us. We've been the best financial, that we won the award last year for the best portfolio return, all of that stuff. But no one ever talks about, what's the actual return you get in your pocket?
Scott, can I ask you to ask Calio or you to do it at the conference? Are you able to put out a sheet of paper, simple, 100 Rand invested, 1,000 Rand, whatever, dollars, rands, euro, whatever, and you end up with $110 in your account? So you have made $10 only. What is the correct name for that after fees and whatever? And likewise, so we can get this thing. Because as you say, if you go out and analyze, and I say it with respect to whatever, very few understand what you did. You get a statement, I'll bring 100 statements every month. Or 6 months, you've got to do your tax and all the shit. You haven't got a clue what's going on there.
Yeah. So
The
there was
statement issued, you don't really know what is going on.
So one of the best lessons, Alan, that I got taught, quite luckily for me in my early 20s, was from Dr. Hannes-Strayer. Now, I always like to give credit where it's due. And he taught me about IRR. And he literally said to me, and obviously the other people in the room, he said, listen, when you understand IRR, you can compare apples with oranges with bananas. Because whether you want to invest in the stock market or crypto or property or give your money to a financial advisor, it doesn't matter who it is. What is the IRR? And just by the way, IRR, unless they're lying, IRR is net. It's what's in your pocket.
So why do you want to worry about rate of returns and all that? And
I'm trying to teach you the financial lingo.
No, I agree with you.
If there's literally one, and you wanted to compare an apple with an orange with a banana, you would say to that, whoever that fund manager is, what is the IRR on my money? That's it. Boom.
So what you're saying, if you took R1 million today and you went to invest it and you get all this nonsense thrown at you that takes out, all you need to ask is to say, what is the internal rate of return at the end of the year? That's all I want to know. I don't want to know anything else. That's what I'm asking for you to click. Anyway, it's simple then. You've made it simple.
That's the silver bullet, IRR.
So that's what we need to ask. What is the internal rate of return, Scott? Okay, well then you can't manage my money. You're not up to standard.
Yeah. Because
that's a great return.
One simple metric can allow you to compare apples with oranges with bananas.
Okay, thank you.
Oh, awesome. And hopefully for everyone else, I know Joyce just said, yeah, I didn't know the difference up until now and often have been disappointed by the actual return on investment, money in the bank. See, that's the same, okay? How many of you have bought a property? Okay, like, let's be honest with you, okay? You bought a property and it's like, you're gonna buy this property. It's going to make you a 10% return, whatever maths, it doesn't matter what, you hear 10%, you probably didn't even understand what yield meant. And it's 10%. You're like, wow, that's amazing, 10%. Like, it's better than the bank. The bank's 6%. Like, that's amazing. Like, I'm going to be, and then you go buy this property. And then you have to manage the property. And then you got maintenance. And then the bloody tenant doesn't play. And the this and that and that and this and that and that. And if you're anything like me, you end up going, hang on, this property's not making me any money. I have to have a job to pay for this property because actually I need more money to pay for this property. I mean, anyone else been through that game? I have lots of times, 16 to be exact. And then you realize the horrible way, actually, hang on. Gross means nothing. It's what ends up in your pocket. Okay. And then I could go into this a little bit more detail because there's also active income, which is how most of us make our money. We work. And when we work, we get money. Okay. So like day trading, people say to me, well, like I'm a day trader. I'm like, great, that's active income. I don't know what you want to call me. I'm someone who likes to share my knowledge. Like I'm active. This is how I get paid my money. Okay. But Warren Buffett says, if you don't figure out a way to make money while you sleep, you'll work until you die. Well, passive income is how you make money while you sleep. And that's why when I first invested in those medical buildings in 2014, it blew my mind. Like, it literally blew my mind. I didn't have to deal with a management agent. I didn't have to fix roofs. I didn't have to deal with vacancies. Literally every quarter, all I had to worry about was opening my bank account and going, is the money there? Which is just bizarre, okay? And then the other thing I enjoyed was dealing at a different level of sophistication was Bruce Saunders, who some of you have met through Asset Mastery and the Mastermind and whatever, and I should get him back here. And he became a good friend of mine. What I loved about dealing with him, and this is sort of answering Alan's question and Joy's comment, was that he would give a target return of like, say, 8%, and then we get like 8.3. And I'd be like, but you said 8, like, why are we getting more money? He said, no, well, I didn't get it quite right. In fact, the building's doing better than I expected. And I mean, that just blew my mind. Like, because for me, it's only ever gone down. And so I want to answer Mike's question or Alan's question, whatever. One of my dreams on our platform is not about what is the Wealth Migrate track record of IRR. My dream is the partner's track record of IRR, because we got lots of different partners, okay? And the second metric I want is accuracy to target return, which is exactly what Mike was asking earlier. So if I deal with Bruce Sanders in America and I've done over $100 million with him and he tells me it's an 8, I'm very comfortable it's going to be an 8. In fact, my belief system might be a little bit higher. Okay. But you know how many people out there will tell you it'll be an 8 and give you a 7. Now I got a question for you. What would you prefer? Someone to tell you that they're going to give you a 7, and you get a 7, or maybe even get a 7.2, or someone to tell you they're going to give you an 8 and you still get a 7. Do you see the dynamics? It's far better to go and be conservative and then outperform than to. And so one of the things I want on our platform, by the way, I've done all the modeling on this. If you want to go and look, it's all about social proofing. I've literally copied Alibaba, Amazon, all of the big, because this is how they do it. Like, how good are their partners? What's their communication like? How do they deliver? I don't know how we're going down this rabbit hole, but I'm answering Mike's question because this is my dream, is where we actually have a track record for partners, and then you can actually see. So now one of you turns up, Shimon turns up with $100 and goes, well, hang on, like this person's promising a 10% return, but they got quite a shady level of communication and the accuracy of numbers is not that good compared to this one that maybe is only promising an 8% return, but has delivered 5 out of 5 projects, great communication, great accuracy. My belief system is all of us will go with that right-hand person every day of the week. And there's nothing I'm telling you that doesn't exist on dating websites and everything in between. Why don't we just have it on investment?
But Scott, you still, the guy taking your money or wherever you put in, you've got to put him under pressure to say, what are you going to deliver? And yes, I understand what you're saying. It's all great. But surely one's got to, let me rather use you, but I say to you, Scott, I'm not interested in you managing my affairs unless you give me 8% IRR. And then he knows you mean in business. He might give you 8.3, well, that's good luck or whatever. What's the market giving? The market's giving 9%. Sorry, I can't give you my business. I must find somebody who's going to give me another 1%. Because that's what the average investor happens to the average investor when you invest. He'll tell you you'll get whatever 8% IRR at the end of the year after all the fees and whatever you assume. And the next thing is you hit with 6, you get 6%. Because when you went in there, you never had in your mind the correct percentage you should be demanding. And all of these companies do not stay by what they say they will deliver. They, in fact, don't know. Am I correct or wrong?
Yeah, yes and no. I think, look, no one saw COVID coming. There are black swans.
No, I understand that. Eliminate COVID and all that nonsense. Yeah. I mean, you can't argue about that. I'm just saying on a normal yearly trading, and you go to somebody let's use Kelly. I go to Kelly, I'll say, here's my R1 million, 100 Rand or whatever. The question is, what are you going to deliver at the end of the year? Because I can only live after costs, after fees, 6%, 5% or whatever I'm getting. And that's what people don't know. I'll lay my investment.
Ellen, I'll answer a question, and then I need to move to Shimon because she's put her hand up. So let me answer because it's a great question. So what Kellyo spoke at the last Wealth Weekend about, which I loved, was that they have a metric where they calculate how they've done compared to the market. So let's just say the market, let's just say you've had a black swan year, which a black swan event is an event no one knows about and it's been a bad year. Okay. So let's say the market on average is down 30%.
Mm-hmm.
Okay. The chances of them getting a positive 8, 9, 10% in that year is like it's
understand.
Okay. But if their clients' portfolios are only down 20% and the market average is 30%, they're still getting you a 10% above market return. Like,
no, understand
so far, you know.
I agree.
Yeah. And so that's the only caveat I'd give you. Otherwise, everything you said, Alan, I agree with. I just as an investor, we need to be careful. Obviously, this year going with this person, this year going with this person, because that doesn't work. But what you want to do is you do want to be able to track performance. And one of the things I love doing with that Anthony does, which I love, is he takes people's current portfolio and then he backdates it 10 years. And he goes like, right, if you've done what we do, okay, literally using the actual, so like no bullshit, this is the return you would have got in the last 10 years. And that gives people a fright sometimes, like in terms of that difference. So obviously no one can predict the future. And you know that caveat with financial whatever, the future doesn't, what's it, past performance doesn't predict future performance. But to backdate stuff and look at comparables, I think is very, very valuable in terms of that process. Shemin, you've been very patient with your hand up.
Thank you so much, Scott. What I wanted to do, if I may, is to share a real life story regarding the Tuesday's event where you shared with us the 17 assets. So it's just so that to wake people up to the importance of this, because we have real life experience. And this is, I lived in Greece for many years. So I think everybody knows the story of Greece and the troubles we went through financially and the extra taxes and everything else. Around that time, I used to listen to a reverend called Lindsay Williams. And he said, this was before QE, so there was no idea. People thought the financial system could collapse any time. So after bailing out the banks before QE, and I was listening to Reverend Lindsay Williams, and he said, don't think, I remember his quote so well, don't think that like he said, even if you own your house free and clear, don't think they can't take it from you. They will put such taxes on your property that if you can't pay them, they'll take your property. And that really woke me up. And he said, and it is in those days, because there was no QE, you need gold, because gold is the thing that will keep a roof over your head and food on the table. So that had stuck with me. And then, of course, in Greece, we started having extra over-the-top backdated property taxes. And they did it in such a way, they put it on the electric bills. If you don't pay them, they cut your electric. And at that time, so many gold shops opened up. We buy your gold, we buy your gold, we buy your gold. And a lot of Greeks went in and sold their gold so they could pay those taxes. And that has stayed with me quite a lot. And now, of course, I moved to the UK, and I think you're probably aware they're trying to now tax property owners on the value of your property on an annual basis. So it was just something I wanted to share, that maybe that there's talk of maybe the gold being revalued at some point or whatever. But as one of those assets you had gold in it. And I think that, like you said, you've just bought some, but I think it's important for that protection to just have that.
Yeah, look, I agree with you completely. And, you know, I'm originally from Zimbabwe, so I've seen what economic collapse looks like.
Yeah.
And
yeah, in Zimbabwe, I
when
think they
people talk
needed
about
gold to
what will
buy
happen if
bread.
America collapses, I'm like, I've seen it. It happened. So look, I think it's a very valuable insight, and you know, one needs to take that into account. And just by the way, my little silent celebration. My property sold in England on Friday, so I'm now officially out of residential completely and out of England. So now that that's done, I can start to tell the story of how diabolical the British system is. But anyway, that's a whole separate conversation. But no, I think what you're sharing is very valuable. And I mean, even down to money in the bank. You know, people were like, "Oh, I got my money in the bank," and then the bank just took all the money. I was like, "Well, hang on, that didn't like, you know." So, but I think also we need to be careful of not going down into analysis paralysis and fear mode and whatever, because living in uncertainty, there's always going to be challenges, which is why diversification becomes so important. And honestly, I spoke about this last Friday. The thing I feel most is the safest way to protect your wealth is being in the right environment with the right people. That's it, simple. Because like if I take myself with just myself, like if I was just a family office client and no mastermind, nothing, for me, the value I get out of hanging with the right people, learning what's going on, understanding what the problems are, that will protect my wealth more than any one asset class. I want to share with someone asked a question up here, Gavin. So Gavin, we've got a calculator on the platform. It's unfortunately only for our property projects at the moment. But if you go here, it's you can see like if I've invested $10, let's just make it 100 to just because I've been using 100 all day.
Scott, your WhatsApp is showing.
Yeah, and you're showing my WhatsApp. Change it quickly.
Yes, these likes are killing me.
Just close your WhatsApp.
No, it's not that. They've changed my screens around. And I got so used to I don't even consciously do it. I change the moment I go to Zoom, I share my screen, it's a long story. Anyway.
Now just change your HDMI cable, Scott. Just swap the cables and it'll go back to normal.
No, but I want it this way around. It's a long story. Anyway,
okay.
I just got to reprogram my brain. I'm just old and dumb, so I got to figure out how to change it. Anyway, so you got $100. And to answer Gavin's question, you can see here the income return. So green is in your pocket, red is out of your pocket. Hopefully we've made this. I actually don't know how more we can make this more simple. And then at the end, you get return of capital plus your capital growth. So your cash on cash is the income component, this green component through. And then your IRR takes into account both your income plus your capital growth. So that's why on our calculator, we've literally tried to make it as simple. I don't know how to make it any more simple for someone, like in terms of trying to make it, so you've got the income and then you've got the income plus the capital growth. That's your IRR. And then you can see down the bottom here, there's your cash on cash return and then your IRR. And you can see here, back to Mike's question, average projected IRR and average projected cash on cash, because none of us have a crystal ball. I can't tell you that building in 5 years guaranteed will be paying you that. I can't do that. It would be, there's no way to do that. And anyone that promises that, you then have to ask yourself a very difficult question of how can they guarantee that? Do they have a big enough balance sheet if the property isn't paying the money? Because it's just a logical question. And the question I always say, people are like, no, but that tenant is amazing. Cool. Do you all know the story of Canary Wharf? So Canary Wharf, London, the biggest financial center, the tallest building at Canary Wharf. It's like 44 stories. In the old days, it used to be the only building. Okay, nowadays there's lots of buildings, but there used to be, like, if you've been in London, if you've been in Canary Wharf, you know what I'm talking about. There's one large building. Okay, so the owners of the building were like, I guarantee you, they were like, no, we're bulletproof. We have Lehman Brothers. Lehman Brothers have been around for 160 years or however long they've been around for. Like they rent the whole building. Like every single year, month, year, whatever, we just get our money. And I guarantee if we have a financial projection, in 5 years, Lehman Brothers will still be paying. I mean, Christ, they've been around for 160 years. Until we had the financial crisis in 2008, and Lehman Brothers went bankrupt. And suddenly their tenant, their entire building was gone. But don't worry, they had insurance, just in case that was a problem. Do you know who the insurer was? AIG. Do you remember that AIG also was about to go bankrupt if the government hadn't bailed them out? I can promise you there are a couple of financial people at whoever runs that company, the Canary Wharf Corporation or whatever they're called, that were very, very worried very, very quickly. And so the lesson, all I'm saying is that no tenant, no income stream is guaranteed. In my experience, never. Even money in the bank in Greece was not guaranteed. Okay. We haven't actually got into the 17 assets. Does anyone have any questions on 17 assets? Camille said, so better to prepare for the worst and have a realistic plan than have a positive outlook. Camille, the way I like to look at it is different to that. So my uncle, who you've all heard his story, highly successful in terms of stockbroking and investing, and also Dr. Hunt Australia, both of them taught me this lesson. Figure out your worst case scenario. And if you can manage that, then everything else is upside. So what Hunt Australia used to teach when you did your property calculations, everyone else out there, all they did was sell the dream. But what Hunt Australia taught was what happens if interest rates go to 25%? Can you afford your property? Because if you can afford your property, then everything else is upside. And just for some of you that aren't from South Africa, because you're thinking 25%, really? When I bought my first house in 1999, the interest rates were 25%. I know in England, in the last 20 something years, maybe 30 years, I know they've been as high as 16%. Yeah, there are. Sherman just said 15%. I thought it was 16, but anyway, 15. So, you know, the 6-7%, you know, it has been higher than that in the last 30 years. And so I like that scenario. Like you go, okay, well, if this happened, how would we deal with this? And if you have a plan for that, then everything else is upside. And I've always thought that's a beautiful way of looking at it. Because it means you don't run around like in, you know, fear. Mine was fixed at 15%. Yeah, no, it must have been fun. Okay, so what did I want to? Oh, I want to share something with you that we've just invented. So I talk a lot about Wealth 5.0, and I'm about to share with you a little thing that I think is going to be something that's going to become quite substantial. Okay, so don't tell anyone. This is off the record. But we've just been working all morning with the team, and we were looking at, and I won't go into all the details, but we were looking at like, what are we trying to help people do? And we went into quite a lot of detail about what does it look like and everything else. And then the thing that I keep getting over and over again is, Scott, it's too complicated. I don't fully understand it. Like, what is it? How does it all fit together? So I want to share with you a picture that we drew. Now, it's not pretty. It's not, you know, it hasn't been put through any fancy scene yet. But what do you think about this? So, do you all know the Parthenon? Just do me a thing quickly in the chat box. Do you know the Parthenon in Greece? It's one of the oldest, most famous structures in the world. Okay, so I'm seeing yes, yes, yes. Okay, any no's? I'm happily if you want to say no, and I'll share. Okay, Chiba says no. Let me go and share it quickly then. For you, Chiba, you're lucky because I even have it live because I had to explain to my own team what the Parthenon was. So the Parthenon is one of the oldest structures in Greece. It now looks like this on the left. But in simple terms, this is what it used to look like. And what's important is that it has this very solid base, okay? And then it has these pillars that hold up the roof. And it's got this majestical roof at the top. So the principle of the Parthenon, and if you're taking it as a metaphor, is that you need a very strong foundation, and then you need the pillars that are holding up, and then the roof is what you get in life. Are we all in agreement? Does that make sense? Okay, so let's simplify that, and let's go back to the pretty little picture that we came up with. So if we take the Parthenon of wealth, or more importantly, what is Wealth 5.0? Well, Wealth 5.0 is that at the bottom, the very first thing you need, the foundation. Where's my mouse gone? Why is it not? Oh, there. The foundation is you need belief. As Henry Ford said, whether you think you can or you think you can't, you're right either way. You have to have the belief that attaining wealth and getting what you want in life is possible. Do me a favor, while I go through each one of these steps, and I want you to be as critical as possible. Like I'm asking for critical feedback here, because this is me attempting to be simple and to really, like when I talk at Success Resources in 2 weeks, be able to talk to everyone so that everyone understands what we're trying to do. So the first thing is you need the belief. The second thing is that there's 3 pillars. The first is that you need a plan. Okay, actually, no, I'm going to do this the other way around. By the way, this is the first time I've ever presented this. What is the thing everyone wants? They want wealth. If you go a little bit deeper, they want wealth, they want freedom, they want legacy, there's a whole bunch of things. But the roof is wealth. Like you want wealth. Okay, the roof is wealth. That's why we're all here, wealth. Now we could go into a whole bunch of details. Different people want different things. They want diversification, they want a plan B, they want wealth protection, they want legacy, they want whatever. But in simple terms, the roof is wealth. So to get to this beautiful roof, it's got to be supported. Well, how do you support it? Well, it starts off with a base. You've got to have a good, strong foundation, belief. And if you don't have the belief, by the way, well, then come along to events like this, look at success stories, because that's how you build belief. Come to the Wealth Weekend. That's how you build belief, because you get belief by seeing other people, you get belief by learning, you get belief by seeing other meeting partners, etc., etc. That's how you get belief. Then you need a plan. Most people are walking around aimlessly, no plan. Secondly, you need access. You got to have access. You got to have access to knowledge. You got to have access to deals. You got to have access to the right information, access to partners. And thirdly, you need a system. So Wealth 5.0 is those 5 things: belief, plan, access, system. And that's how you get wealth. What do you think? Hit me with it. But because what we've been trying to do is really try and simplify, like, what is it that we actually do? Now, just for the record, if you come in at our free level, the Wealth University, and you do the investor roadmap, we're offering you the same thing. We're offering you those 5 elements. If you come in at Wealth Going Global level and Wealth Hackers, let's call that the middle, we're offering you the same thing. And if you come in at the mastermind level, we're offering you the same thing. The only difference between the 3 is the level of support that we're providing to help you get the result. Does that make sense? Because at the free version, you don't even talk to a human. You can just go online and do it. At this level, Wealth Going Global and Wealth Hackers, etc., you turn up between Alex and I, we do the weekly sessions. We're there to try and support you. You still, we show you how to do the plan, but you still do the plan yourself, etc. And then at this level over here with the mastermind, it's done with you for you. The family office comes in, they do it all for you, etc. Does this make sense? Please, I'm asking for constructive, critical feedback. Like, thank you for all the kind words. I appreciate them. But
so is that building's going to, at the end of the day, is going to give you the correct IRR.
Correct, 100%. And,
so
and that's the point, Alan, is that, like, if someone came to me and said, put a gun to my head and said, the single most important thing that people need to know when it comes to building wealth, it's what you are really, really focusing on today, which is IRR. Okay, it's like, right, that's how you can determine the difference between everything and anything. Now, how do you get the right IRR? Obviously, there's multiple components to that, but IRR is the metric, the financial metric. If there's one number, black or white, that you need to use to compare A, B, C, D, it's IRR.
I don't have to worry about anything else. I just want the correct IRR, and you supplying the building that normally should get you to the correct IRR.
Correct. Yeah. And that's why the pillars, like the Parthenon always just resonated for me. That's why the pillars.
No, sure, I understand.
But there's multiple pillars that, that one needs, Camille, interested in the right result. Love that. IRR. You got your hand up. Is there a question you got?
Just a comment, Scott. Excellent way. One of my joys is helping people to understand things in a simple way. So I just wrote something down. You can call it sorry to be crude, but you can call it a brain fart to help people understand the way I saw it. Maybe it could help. The roof is your goal is freedom, right? And the vehicle that takes you there is the wealth. That's what we're all after. The pillars are the map which we follow, and what drives it is the belief, which is our driver. So I don't know, it's just, for me, it's like a very simplistic way. It can help people get an overall viewpoint. That may help me not. I just said I'll just throw that in there. But phenomenal representation, Scott. Appreciate it.
No, look, thank you. And look, I think the biggest challenge I've had, I'll tell a funny little story. Chantal's just put it in there. I'll go back and review these when we're finished. Because literally it's a work in progress. Like, we literally just spent from 9 o'clock till about 11:45. I had to run off and get ready for this presentation. So it's hot off the press, and I'm excited to share it. But my challenge in life has always been giving too much and going into too much detail. So when I did my master's in London, for the dissertation, which is where you write your final kind of thesis and whatever, I think the limit was 200 pages. If it was more than 200 pages, like, you weren't allowed to be 200 pages. Mine was 360. And so the professor calls me in, and this is for my master's, and he calls me in and he says, listen, we have to fail you. I was like, why? And he said, well, the limit's 200. I'm like, okay, well, based on what? He goes, no, it's 200. He says, anyway, we've got to go to a board review. Anyway, long story short, how this ends. They go to the board review. They decide not to fail me. They decide to offer me a PhD. And rather than taking 3 years to do a PhD, I can do it in 1 year. And I don't know, maybe my brother's becoming a doctor, and I was like, maybe I should just beat him to it and I could be Dr. Picken. But I was only going to do a PhD to beat my brother. And I thought that's not really a good use of my year. But my point of my story is that I've always had too much information. And even the feedback I was given just this morning was it's a lot of detail. It's quite complex, difficult to understand, you know. And so what we very consciously are trying to do is try and simplify stuff so that it's understandable. But on the other side of the fence, what I don't want to do is dumb down things like IRR or cash on cash, because honestly, then I believe that I'm not empowering you to win in the financial world with or without us. Does that make sense? And our intention
That's perfect,
is not,
Scott.
sorry, just
I was
quickly,
just thinking,
sorry, just quickly, mate. Sorry, just quickly. Our intention is to empower people, not to get clients that are subservient to us. There's a big, big difference between those two. Because if you're empowered, you can go anywhere. I still want to give you the best product, which means you consciously choose to be with us. But I don't want to like indoctrinate you and you're basically stuck and you don't actually know, and which is pretty much how everyone is on the planet right now. Because as Alan keeps going, they don't know the difference between an apple, an orange, and a banana. So it's actually who's the guy that is part of the, I don't know, some society that you respect, and he's a financial advisor. And I tell you what, he's the captain of the cricket club at my little town, and so I'm gonna trust him. Anyway, sorry, Camille.
you know, I get you. And the thing is, what I like, and based on what you're telling me now, how you can prevent that dumbing down while retaining the overall view of holistic simplicity is that you have the roof, you have the pillars. Then each of those pillars, you can make like small bricks of the different things that make them up. So at one glance, you can have an holistic overview, and then you can actually drill down in the same picture, if you get what I'm saying.
Yeah, no, I like it. Oh, dude, we can play with this metaphor. Like, don't get me wrong, I haven't even started. Like, in 5 years from now, you guys will be like, oh, I remember the day that we were on that webinar live or Zoom meeting, whatever you want to call us, where Wealth 5.0, like, was literally like spoken about for the first time. So
Yeah, then and what will be nice about that, Scott, if you present it in that way, how you're suggesting, is that people who want just the big picture and they're afraid to go further, they can see it. Those who want more detail can go in, and those are very detail orientated can actually garner that depth from how you present it.
yeah, no, like as I said, someone was asking, you know, the more details. Alex, you know, if you meet with Alex around the mastermind, you know, the 3 pillars that we talk about are strategic wealth plan, number 1, access to income generating assets, number 2, a smart investing system. So again, any one of those 3 things I could talk about for 2 hours each. But when I'm on stage with Success Resources, I don't want to confuse people. So it'll just be access, because every human that can speak English understands plan, access, and system.
Sorry, Scott, can I just add one last thing? Don't want to dominate the conversation, but your marketing message is why, right? That's what you need to sell, is the why, and how, and the details come in through partnership, whether it's on this platform of Wealth Going Global, Wealth University, and your family office. So in that way, you're maintaining the integrity of what you have without giving away too much for those who won't appreciate it or don't hold value for it. So that's how you actually like also filter people and get people who are really interested, but you're not dumbing down your message at all.
Yeah. No, I appreciate that. Look, it's a work in progress. It's a work in progress, because what we're trying to do, and which Alan kindly, you know, really kind of talks a lot about, is that the industry is opaque. The financial industry is opaque. People don't understand. And my belief system is it's like that on purpose, because if people don't understand, you can charge them fees. They don't know what they're doing. They work hard. They give their money to pensions, and people earn a lot of money. The financial industry earns a lot of money by the lack of understanding. So you're taking on a massive gorilla, a massive gorilla of everything through indoctrination, schooling, university, and everything in between. And so what we're trying to do is figure out how to teach people and show them that there's another way without overcomplicating it, scaring it, making them feel that they're not good enough, whatever. So, but it's, it's only been something I've been trying to figure out for 28 years. So that's a work in progress. So. Well, let's say no, let me lie about that. It's something I tried to figure out for myself for 7 years, and I've been teaching people for 21 years. But I do think I'm a little bit better than I was 21 years ago. Okay. Any other questions? Shemin, yes, I love that Tony Robbins live with passion. I agree with you. Any other questions? Anything else I can help with for this week? I know we went through the 17 assets. As always, you can ask questions anytime you want. Next week if something comes up. If there's no questions about 17 assets, then hopefully I've given you quite a lot of detail. I did, again, if I share my screen here quickly, I did do the synopsis again for you. So I'm quite proud of these synopsises, by the way. Takes a hell of a lot of work, but I do them. So if you go down here, you can see the, what am I done there? Where's it gone? Oh, there, modules. Yeah, so all the stuff is here. All the calculators are here. In terms of the, by the way, someone was asking for an IRR calculator. There's an IRR calculator. But if you go to this part 2 summary, again, you've got all the different asset classes. Oh no, that's the wrong document. Oh shit, put the wrong document in. Oh, okay. I need to update that. Let me go and get you your part 2 summary.
Can I have a quick question, Scott?
Just fire away. Just very quickly before the question. If you see a mistake like this, you just tell me. Like if it says summary, it's supposed to be a summary. I've obviously just uploaded the wrong PDF, which is my apologies. But yeah, anyway, how can I help with the question?
Just regarding, I think the talk on Tuesday, you're saying that the wealthy people don't do REITs, they do like direct investment because you're cutting out all the middlemen, right?
Yeah.
But then I think when you showed like a typical breakdown of what wealthy people had, and they did have REITs in there as well. I'm guessing it's more diversification. Don't do everything in one way. Is that the answer? Is that why they have REITs as well?
Yeah, I'm not, just to be clear, I'm not ever saying, like nothing I'm saying don't do anything at all. Does that make sense? So there is a place and a time for REITs. And particularly when you're doing portfolio construction. I was just trying to show the difference. Look, up until 10 years ago, REITs were the only way to invest affordably in, let's call it commercial property. It was literally, it was the only way to do it, and it was the only way to get diversification. Whereas nowadays, you can do it using technology. However, there's downsides to REITs, the very close in correlation to the stock market, but there's also upsides to it that you can sell them quickly. There's a lot of liquidity in terms of that process. So but actually, we're going to go. No, we've already done it. Actually, if you go back to that portfolio of those wealthiest people, which is I think the visualization you're referring to, they had about 8% of their capital in REITs.
Yeah.
So yes, you're 100% correct.
Okay, thanks.
And just by the way, for all of you, I've realized a mistake, which I'll go and fix. But here's your summary. I uploaded the wrong document, so I've done the work but made a mistake. But anyway, here's all the different assets, and it's quite nice. It's quite short and sweet. So benefits, growth, risk, case study, etc. So you got all of them here. So yeah. I would strongly recommend, no matter who you are, no matter what level of sophistication you're at, always try and go back and just read the cheat sheet, because I take a lot of time with the cheat sheet. Yes, I use technology, I use AI, etc. It's brilliant. The power of technology is phenomenal. But I do reread them all, and I make sure they're properly done accurately. I don't just regurgitate. And the reason I'm doing it, I want to build a really valuable asset for you, so that 2 years from now, you can come back and you don't have to watch a 2-hour recording or whatever. You can literally just read the cheat sheet. So that's why I'm doing it. Where do you find the docs? Reg, everything is in the course. So if you go here, oh, I've probably done the wrong one again, haven't I? So everything is in the course. So if you go here to the course, so just remind you, you go into Classroom, you're in Wealth University, go into Classroom. Obviously, you've all paid for this, so this is not available for free, but as everyone's paid for it, they can come in, and you've got the different modules. So you can see Module 1, Module 2, Module 3, Module 4, Part 1, Module 4, Part 2. So you just go in, here's Module 4, Part 2. Again, you've got the recording. Then I do this. Again, I don't know if this is valuable for people, but I just take screenshots of some of the most important stuff that I've tried to add value to you. Again, I'm trying to provide you with snapshots. There you've got your homework, your silver and your gold. You've got the calculators, which I promised to give people. And then you got your resources. And those docs are these resources. So I will just update this module 2 summary. I made a mistake here. I've just uploaded the wrong doc. There are the slides. There's the video I promised you with from Gary Sachs on large-scale residential. The emerging trends in real estate, someone asked me for that, so I gave you that, and I gave you the full commercial real estate report 2025. Back to my thesis conversation. I've given you enough information to keep you busy till 2027. but if you want to keep it short, read the synopsis.
But I popped you a question.
Yes, who's asking? Chiba. Yeah?
I sent you a question there in the chat.
Investments, which, where is it basically? Are there, how would you compare investing between CRE versus living annuity? I'm not 100% sure what a living annuity is, so let me just explain myself quickly. I'm not really a fan with what I'm going to call traditional financial products, okay? So I'm not going to even sit here and try and sound like an expert. I've always pretty much done what you call primary market investing. So I've done, property and private equity and, companies and whatever. I haven't really done much listed or traditional stuff. So I'm not even going to try and sit here and say, I don't even know exactly what a living annuity is. I can guess from the words, but to compare the two, I'm not at a level to do that. I can go and do the research and answer you next week, but I'm not going to try and sound like an expert because I'll just mess it up.
Is there anybody else on the group that perhaps have a view?
Let me Google it quickly. What is live? Okay, well, no, actually, I'm gonna use my best friend. So just by the way, my psychologist gets really upset with me when I say this. But anyway, let's ask my best friend. What is the difference between commercial real estate and living annuities, and which is better for me as an investor?
We are seeing a different screen in case you wanted us to see the answer.
I don't know what I'm gonna do. I don't know how I'm gonna do this. Anyway, you missed a live demonstration of ChatGPT. So you've got commercial real estate. What is it? Pros, cons, living annuities. What is it? Okay, let me read what it is. A retirement product mainly in South Africa where you take your retirement savings and place them into a portfolio of shares, bonds managed by an insurer or asset manager. You can then draw down on income between 2.5 to 17. Okay, that's pros and cons. By the way, no wonder I don't know what it is. I've never invested in South Africa. I went to London when I was 21. Which is better for you? It depends on your stage, goals, and risk appetite. If you're pre-retirement, growth-focused, commercial real estate is usually far superior. It compounds wealth through cash flow and capital growth and provides diversification into hard assets. If you're in retirement, need predictable income, living annuities provide regulated drawdown options and flexibility. Though you carry investment risk, you could pair them with CRE for stability and high yield. If your goal is legacy and passive income, CRE aligns more strongly. It gives you hard assets, generational wealth, and protection from inflation.
Hi, I'm just on a webinar with Scott.
Sorry, Kelly, you're talking.
Oh, sorry, Scott.
My recommendation for you, based on your wealth philosophy and focus on freedom plus legacy, commercial real estate is likely a better fit as your core wealth building vehicle, while with living annuities as complement, especially if you want regulated retirement income. The key balance, CRE for growth and income, annuities for stability and liquidity.
Great. Thank you. Now I wanted your view, but yes, I got that.
Yeah, look, I'll tell you what I'll do. I will share that so you can share a chat in the. I'll share it in the chat. So just click on the link if anyone wants to read that. Link to CRE and living. There are. So it's the links there if you want to go and read up on the chat. Look, the power of technology is phenomenal. Okay, and I mean, we can actually ask anything we want. And one of the reasons that I'm so comfortable doing what I do is that I don't mind if anyone asks me a question and I don't know the answer, because you can't know everything. And so my very next answer to the way I would answer that question outside of ChatGPT is I'll go and ask Anthony from our family office. Because, and that's why we partner with them at the mastermind level, because we don't have all the answers. And specifically when it goes into the listed regulated products, because remember, that's a listed regulated product. I don't do it. I don't use it for myself, and I've never sold it. I'm not regulated to do it, and with no disrespect, but I've got no desire to sell old school products, old school, old world. I could be wrong. That's just how I feel.
Where did you copy it? Did you copy it into the chat, or is that the link? Okay.
I did. I'll put it in the chat there. Yeah.
Thank you very much.
No problem. No problem. Cool. Okay, so I want to finish with an exciting story. About 2 months ago, my son and I were out on the boat again. We actually had clients that were in from Success Resources, and we had to be rescued. This year, we've probably been rescued on that boat, I don't know, at least once every month. And anyway, I sent the boat in for repair again, and they came back to me and they said, Scott, your boat is dead. It has died. And I said, well, we've done quite a good job, because we took it from brand new to dead, like not fixable, dead. And so it got sold for parts, okay, literally. And anyway, the exciting news is today our replacement actually arrives. So in 1 hour and 43 minutes, John T and I will be able to get back on the water, because we haven't been able to get on the water for 2 months, which is quite a big thing in our world. I'm not going to lie. So I'm just sharing my excitement with you. We can't wait. So, and just by the way, how excited my son is. He absolutely loves rugby, and he's cutting his rugby practice short so that he can be here for when it gets delivered. So, got nothing to do with what we've spoken about for the last hour and 20 minutes. And I also think it's got everything to do with what we speak about, because when it makes me emotional. When you know your why, then everything else becomes easier. So, yeah. With that,
send us a pic. Somebody says send the pic of the boat.
Yeah, we will do. For all of you that come to the Wealth Weekend, anyway, we'll get to do boat trips and have fun, and you'll get to see why I like to do the Wealth Weekend in Eisner, and I like to live here. But yeah, I just wanted to share that. I don't know, like our Friday family and our mastermind family for me are like family to me, and so yeah, I just share those little moments with you in terms of that process. But on that note, I don't know what you thought of today's session. I think we covered some pretty important stuff today, and I hope that maybe even might be worth rewatching some of the stuff. But there were some really, really important things. And just to remind you, the 3 most important things I think we've discussed. 1 is back to that belief of, am I worthy or allowed to be at the table? And the honest truth is that all of us feel like that, and every one of us deserves a place at the table. And the second one was the language. Learning the language of investing. You have to know the language of investing to play the game. And as Alan said, once you know the language, you can play the game with anyone, because you can ask the right questions. And the third one was what we did towards the end there, which was just simplification. And how does it actually all come together? And hopefully you walk away with a bit of confidence that it's not as complicated as people try and make out. And but you do need the partners and the different pieces of the puzzle to put it in place. And I'm yet to meet someone that has done it all on their own. So well done for being part of a community. And on that note, have a wonderful week. Yes?
Can I take 1 minute of your time?
No problem.
We're going to the Wealth Weekend in 2 weeks' time, which is exciting. I've been to one brilliant, everyone needs it. Is it possible for me to ask you to ask Calio to do a presentation on what is the ideal investments we should have? And coming back also, ending up within the IRR and what we just need to look at. For instance, what portfolio, you can buy your own stuff and whatever if you can go out and do what you like, buy shares, get on it. But what these people do, they don't really come in saying, this is what you should have as a portfolio. And I understand everything could change, but you should have gold in your portfolio. This is what Calio do. We go out and we buy gold. We go because there's a gold run and it's going to do diversification that comes back into. You will need to go and buy some property, X, Y, Z, for the following reasons, and give a talk about what's the ideal investment. I understand it'll change, can change, but it shouldn't really change overnight or over 6 months or whatever. And just so that we can learn and improve our knowledge on what investments we should be holding and what we shouldn't be touching. I mean, they were saying, oh, the dollar's going to crash or whatever, or what's their view on the dollar's going to crash? I think we need to know this type of stuff from the experts which you have. And what we read about, all the tripe we read and whatever. No, the dollar's never going to collapse. It's just absolute total nonsense what's been spoken about. But you need gold. You need some crypto in your portfolio. Now, who's going to buy the crypto for us? Or can Calio buy the crypto for us? And what's the costs on it? I don't know if I'm out of line or because these are the things that are not shared with people. What does it cost for Calio to look after your portfolio? Let me be blunt. Instead of waking up at the end of the time and there's all these costs coming through, you don't know what day of the week it is. I don't know if anybody agrees with me that's what I would really love to see, that when they come on, they go back to basic level of investing. What investments do you need? How do you make your portfolio grow? What do you need to do? What should be done? Because that's what it's all about. The rest is just respect nonsense.
Yeah.
I don't know if you agree with me or not. Do you agree with me or am I out of line?
I think that's a great session. So I'll plan for that.
They must do a session on it, on what investments are they going to go and buy for your people, and it's going to be gold, what's the cost, what's the review, what's accepted. I think that would be great. Instead of listening to all this trash that we listen to when you go to other people and all that. It's incredible. I could lecture you on it, actually.
I think that's very valuable. I'll add that as a session. Look, it's one of the reasons with the Wealth Weekend, I give people overview of what the agenda is, but I don't give you tight at 8:30, we do this 9:30. I'm flexible. I adapt. So
no, sure.
I can easily include that. Awesome.
Can I say something, Scott?
Yes,
Sorry,
please.
I know we're over. I just wanted to say thank you to everybody for being such rock stars about my community. I know I didn't communicate it well, and I probably should have introduced one group at a time, but I've been waiting so long for this WhatsApp community that when I got it, I was like a kid on Christmas. So I'm going to leave it to kind of find its way this weekend. I won't post anything, but the theory behind it, I just want to show you because I haven't even had time to show Scott. Can I share my screen, Scott?
Go on.
Okay, so this is the theory behind it. In my inbox and my WhatsApp, I only have those. So you should just have Wealth University. And then if you archive all the groups, they can stay there. So you don't have to get messages all the time. I'm just trying to go to my next screen here, which I can't get to. But anyway, so that was a theory. It's supposed to be more
Just click
simple.
down the bottom there, Kelly. Down the bottom, you see right down the bottom, there's a little green arrow.
Well, yeah, this is what I was trying to show anyway. So that's what my archive looks like. So all my groups, I have 77 groups with Scott. They're all in the archive. And then the other ones, you see, so if I click on this Wealth University here, so if I show you in my WhatsApp, if I can go in there, you see, I'm not the tech one in the company. Scott, how do I get back to my inbox? Okay, but anyway, basically, if I click on that tab I showed you guys, you should be able to access all the groups through that one tab and keep all the other groups in your archive. Does that make sense?
Yeah, I think that's
Okay.
what I'd ask you to do, Kelly, is let's make a video, because obviously a
Okay.
bunch of people had bounced already. Let's make a video that we can share with the on the general communities and whatever. Just explain to people. I think it'd be very, very valuable for people.
Okay, I'll do that.
Yeah, I think that's a good idea, Scott, because otherwise we all phone Kelly on what she was trying to explain.
But then, Scott, you can only post in one group when we do this. So then you only post in the
I'm
announcement
taught.
group.
I don't like. I don't know how this works. So
Yeah, I'll spend some time with you too.
cool, awesome.
Okay.
Hey, everyone.
Thank you.
Cheers. Have a nice weekend. Bye then.
Thanks, Kelly. Thanks, Scott. Cheers.
Thank
Bye.
you.
Bye then.